Why don't you talk a little bit about, sort of how you find these banks? My experience with banks has really been that it's kind of looking for a bank that where the size of the loan and the type of the deal matches what they're interested in doing at that particular moment in time, and that can change, somewhat rapidly,
And that's about the same thing I do. I just, being neurotic, I am not one for the conversational interface. I don't, if there's a lot of things to know and like the US
What does
capital.
that mean? What do you mean?
I'll get there. The U.S. capital markets constitutes a lot of things to know. Finding things out anecdotally because I saw so and so at real estate group and so at the Palm or whatever is a really crappy way to figure out who's lending. And so is calling 30 lenders a week and asking, "What are you doing this week?" Because then you're going to end up doing anything else for a living the next week. We use public data a lot. We use public data sources that again are public, but people don't know a lot about a lot. Actually, a bunch of it comes from the title industry. First American has absurd data quality. It's eye-wateringly expensive, but it's great. As loan documents get recorded across the country, we're getting a lot of information about each one of those loans. So I can even set alerts up, like I'm looking for something with 35-year AM. I'm looking for something that is bracketed like XYZ in leverage and rate like this and recourse like this and these loan doc provisions. And as those deals get recorded, 100% of those documents are getting, saved, are searchable, and are abstracted so the text is searchable. So, I've got data records coming in all the time that show exactly what the marketplace is doing, not just like big securitized Fannie Freddie stuff, but like, balance sheet stuff, like what banks are doing.
You want to explain to people who may not know what a participating lender is? It's what it sounds like, but if you want to tell people, I could also explain either way.
Yeah, so like National Capital also does a lot of participation. You guys have mostly seen me on here with Brad. Brad is the man. So like if you've got a $10 million loan, usually the way it works is the first trust lender will do like, let's say 7 million of it because they top out at 7 million and they'll find somebody else to do the next 3. The way these guys work is the primary lender is doing 1% of the deal. And these guys are bringing basically all the capital. So they're participating, quote unquote, but they're your lender. It's just somebody else is doing all the paperwork basically and the local compliance, which is how a CDFI is able to lend nationally, and that's the secret sauce. Ever since COVID, Fannie Freddie got the heebie-jeebies from small balance, and it hasn't really recovered. So right now, it's probably 150 basis points wide. Either way, all of those programs have yield maintenance or defeasance prepay. So you're locking in for a long time. You can't mess with it. It's literally a bond. You can't do anything. So I was talking to one of my sponsors a little while ago about, oh, hey, I'm trading this property back to this guy, and he's giving me this one, and we're switching ownership interest and all this stuff. And I'm like, did you run this by? Because they're all Freddie SBL deals, but did you run this by the lender? They're like, no. What do you mean? I'm like, okay, you're in default, and
Yeah,
because it's
totally.
a securitized instrument, you may or may not have committed felony wire fraud. So just take that operating agreement, tear that up, just say that never happened. Ask Freddie for permission. I'm going to pretend we never had this conversation.
No, 100%.
Like doing anything, and I don't mean to scare anybody away because this is the reason why you have the car dealer in the equation, which is us, basically. Individual borrowers aren't supposed to need to be familiar with every single line of securitized loan documents. Your loan documents from a bank are bank loan docs. They're 20 pages. Your loan documents from Fannie or Freddie are like a Tolstoy novel. It's going to be like 600 pages. And nobody expects you to read it. We just expect you every time you want to do anything, just call me and I'll be like, you can do that or you can't do it. Or here's
Yeah,
how.
but that one seems pretty basic. Like your lender should know who their actual borrower is.
That was
I mean,
pretty
I will
egregious.
say that
Yeah.
seems a little basic to
That
me.
was probably like I've gotten like borrowers who got in trouble for like changing the windows or something, and I'm like, okay,
Yeah,
Freddie, you're off your ass.
that's dumb. Yeah,
But
yeah.
yeah, when you're changing the underlying credit of a transaction that has been securitized to like some sovereign wealth fund in Singapore or something, you should maybe not do that. Even with a bank, you shouldn't do that. I don't care if you're allowed to, you shouldn't do it.
Yeah, the one thing that I've noticed, like we have self storage and with the insurance company lenders that will do that, I know that people who rely on local banks primarily, like I do, wouldn't be familiar with, is that say you have a 7 or 10 year loan, they'll come out there just like randomly in year 3 and inspect the property and then send you a list of things that you need to fix, which a local bank will never do. At
Not
least
really.
not
Yeah.
in my
Unless
experience.
they're looking to get you got. Like the one thing
Yeah,
I
yeah,
would
true.
say is for local
Yeah.
bank deals, because your loan documents aren't 7,000 pages, you should read them. And if you're doing really anything above 4 units, you should have real estate counsel. This does not mean your buddy who, a lawyer who happens to own a title company or happens to own an insurance company and does real estate stuff on the side for you for a couple bucks. You need somebody who is borrower counsel because like even bank loan docs, if you're behaving yourself, they're usually great. there's a surprising number of gotchas in even the most permissive bank loan docs that can, if they're looking for a reason, and right now a lot of banks are looking for reasons, they can, accelerate you to default interest, which is 18%. And the minute you, fail to be able to make your default interest payments, they can take your deal. And they don't have to jump through a hell of a lot of hoops to do it. They don't have PR headline risk like Freddie does. They can just take it. And it's, again, it's not scary. It's just, RTFM, read the loan docs. Everyone focuses on the rate in debt. That's a pretty, unless you're going and doing capital A affordable stuff, like you're going to lift or something and you're getting mezz for 40 basis points all in or whatever it is. Right now, like the difference between a decent rate and a good rate is 25 to 50 basis points, and probably less than that. And there's a lot of other qualitative stuff in there that's going to matter a hell of a lot more than 25 or 50 bips. So whatever example I'm going to give is probably not because, it was 15 bips lower than somebody else. Now, between a pretty good rate and a terrible rate, like the point is you can only get so good. You can get as bad as you want. So there's lots of people out there who will give you atrocious deals, but between the people who are trying to give you a good one, rate standpoint only, the difference between the best one and the rest of those guys is not much of a difference. It's not really even worth talking about. You've got a deal that's coming out of construction and leasing up right now, unless you already committed to it to get your construction loan way up, like that forward thing I was talking about. You just got an open vacant deal. You probably don't want to go lock it in with, 5, 7, 10 years with Fannie or Freddie right now at 7% with defeasance prepay.
That's fucking insane. That is like insane.
I
mean, that's business person malpractice.
Now big balance is different. Big balance rates are pretty good right now. I mean, HUD rates are getting down towards 5.25, but you got to have a $10 or $15 million deal for HUD to make sense, or you got to have a lot of little deals. So what I'm telling people to do is go to
the bundle.
Yeah, exactly. Just get a lot of stuff off of your, either whether it's hard money or construction or whatever, get it into one of these QSO credit union deals, and you have no prepay. You have a reasonably good fixed rate. Let's call it 7%. You're on 30-year AM. They'll probably cash you out in some cases. You just lump more and more deals into that if you have a steady pipeline. And in 2 years or whatever, when rates are really low, you'll have 5 or 6 deals in there. And it doesn't matter when you financed each one of them because they're all open prepay. And then you bundle them all together, do one FHA loan, and walk away with several $1 million in tax-free cash out money. And you do it all again.
The open prepay thing is just, for people on the call, like, that don't really appreciate that. That is gold, right? That's an incredibly valuable tool.
Credit unions in general don't expect prepay penalties, just as a matter of course. They just, and I don't know why, for whatever reason, they just don't. They tend to be a little more expensive than the banks. So like the credit unions, their cost of capital, because they're borrowing to lend in a lot of cases, their cost of capital has not been where the banks are. I don't think, treasuries have gone up, 75 bips in the last month? But the credit unions were never under 7 once since 2021. They have not been under 7 one time. Between 7 and 6 3/4, people the danger is, conflating the feeling of being a winner with being a winner. Just because you've achieved an extra 25 basis points from cajoling some lender, you get 25 bips off your rate because you really beat the hell out of somebody, compared to I'm going to owe, $500,000 in prepay the minute I realized that I locked in for 4 years at 7.5% because I'm an idiot. Don't conflate feeling like a winner with being one. And also, the credit unions happen to be in this position because their program happens to have lined up with today's circumstances. It's not because anybody bludgeoned them into it. It's not because they're there by design. It's not like every credit union in the country got together at some secret summit somewhere and decided, hey, let's do this. We're going to price the banks out. It's just, it's a natural consequence of the way credit unions structure and lend. Be aware of stuff like that, or work with somebody who's aware of sort of the levers that move the world in that sense, more so than anybody who tells you, oh, I was really hard on them. Oh, I gave them hell. Nobody can really do anything with that. You can negotiate a little bit around the margins by being persistent or by beating somebody up. In general, the capital markets are mostly a world of hard surfaces. You can only get so far. You can't, it's not like there's, IDs this pop B in Doom where you can walk through walls. There's none of that. Nobody can do that. Negotiation's just not worth that much in lending. It's worth a little tiny bit here and there.
Yeah.
But it's worth a lot in development. It's worth a lot in what you guys do. It's not worth.
Well, right now there's not a lot to negotiate because the world is where it is. I think when money was cheap and everybody was trying to grow their bank, bank and people were getting real aggressive to get business, I personally felt like you had a lot more leverage to negotiate than right now.
Ultimately, the things that define where the floor is are the same things that define where the floor is. The floor just moved. To your point, the idea that every bank and their mother was trying to get bought out by a bigger bank, that was a driver. But even that's not a driver on rate. That's a driver on like prepay and leverage and stuff like that. That's why Hingham does 35-year AM, stuff like that. In general, cost of capital is cost of capital. So like I always kind of tell developers whose bread and butter a lot of the time is negotiation and that kind of like sort of poker face stuff. It's not worth anything in my universe by and large. What's worth stuff is knowing a lot of detail and being able to parse through it very, very quickly, faster than people can parse through it, and sort of getting to the answer in a way that is more efficient than screaming at somebody persistently on the telephone. It's very common for banks to be like, oh, and we also need 30% of the loan amount on top of what you use to close the deal and on top of the operating account and on top of the interest reserve to sit here for, the duration of the loan. And now by sit there, they don't mean it has to sit there. Like you can use it like a bank account. It's a bank account. It's your bank account. It's not an escrow. But the average balance has to be above a certain level or you're in default. You have investors in your deals, and those investors are not real estate developers, because real estate developers don't tend to have massive piles of cash just lying around, because if they did, they just develop more real estate. Go to your equity guys and say, hey, doctors and dentists, why don't you put your deposits with this bank? I'll get credit for it, and I'll impute a little more equity to you in the deal, because then I can lever it way higher.
Yeah, and they can be paid, whatever other people are being paid. The bank will pay them some interest.
They're getting whatever market. I mean,
yeah.
So an example, Varda just moved our operating account and my holding company's operating account to National Capital Bank. And, we may raise an equity fund, and we will probably do that at National Capital, at least partially, if not entirely. Like to a certain extent, we can, we don't develop real estate. We don't need deposits anywhere. We can use those deposits as leverage on behalf of our borrowers if we want to. Stuff like that, like think out of the box when it comes to deposits, because they just want the money. They don't care whose it is. They just want you to be able to tell them credibly that it's going to stay there and that it's your ass on the line if it's not there, because then you're in default.
Yeah, I mean they're very deposit constrained right now. So banks are, and they need deposits desperately to meet regulatory requirements, et cetera. So you're going to, for years, I would have term sheets where there was no deposit requirement, and now many of them, not all, but many have deposit requirements, which change your
Oh, sorry, keep going.
Which changes your overall, cost of capital, right? I mean, if you're having to keep funds in a bank, you're not getting paid that much yield. It's increases your cost of funds effectively.
Yeah, the only people where that makes sense is if you're somebody that has 2,000 stabilized units, right? Those are with some stabilized lender, whoever it is. Whether it's Fannie Freddie or CM, whatever it is. Stabilized properties don't tend to have a depository requirement. So you've already got operating accounts, and you could be emptying those operating accounts every month. What matters is average monthly balance. So take your collections, take 0, and just take your collections, divide it by 2. That's that average monthly balance for that account. So if you've got a lot of stabilized properties, you can move all those accounts in. And if you've got them all with pick a big bank that doesn't really lend to anybody, Bank of America, right? Nobody here does visit Bank of America as a lender. Move that stuff from Bank of America to somebody like National Capital or Old Dominion or somebody local who will let you borrow either more or on, at times, vastly better terms because of it. So that's the other thing is deposits are one of the more negotiable things. Deposits will move the needle between who is nobody and who is somebody when you walk in the door of a lender right now, more than any other single thing you can do other than not being a criminal.
But yeah, I think also just on the hard money front, I think just like what Chris was saying, there's just not a lot of negotiating now because, hard money lenders like myself, we have a lot of incoming deals. People need money and people are willing to pay for it right now. And investors who invest in hard money loans expect high yields, high returns. So there just isn't a lot of ability, even if you wanted to negotiate. And so my recommendation is kind of take the best deal you can get and with the best people and kind of plow forward, and look forward to a better time for rates. And really the market will hopefully get better with better rates.